Hello, everyone, and welcome to the Sustainable Finance Podcast. My name is Paul Ellis, and I'm your host for these programs about developments in this fast-growing industry. Investors today have to consider sustainability and climate resilience across all asset classes in a diversified portfolio. In this episode, we speak with two professionals from Schroders to hear how these factors are integrated in energy infrastructure and real estate. David Boyce is head of Schroders Greencoat US, which focuses on renewable energy infrastructure. Craig Morey is the climate lead for the Schroders Real Estate team, which makes direct real estate investments across the UK, Europe, and Asia. Both of these teams reside inside Schroders Capital, the nearly $100 billion private markets unit of Schroders, which also includes private equity, private debt, and credit alternatives. The key message for Sustainable Finance Podcast followers in this episode is that climate resiliency and returns are not mutually exclusive concepts. The current shift to climate resiliency in renewable energy and infrastructure is opening up very attractive investment opportunities and enhancing current investments. Hello, David and Craig, and welcome to the Sustainable Finance Podcast.
Thanks for having me.
Thank you.
It's a pleasure to have you with us today. And David, let's begin with some questions for you.
Okay.
First of all, we want to know, what does the concept of climate resiliency mean for Schroders Greencoat as a renewable energy investor?
There's probably two ways we think about it. One is a bit more macro, and then one is more on the investment level. In the macro sense, obviously, we're thinking about climate change. We're thinking about a greater energy transition away from greenhouse gas, away from carbon. We kind of invest along three broad themes. One is to green up the electric supply with things like wind and solar, then focus on the demand and transitioning some of the demand from, say, natural gas for heating to things like green electrons to provide heating. And then the last one are a basket of things that are tangential to that. Hydrogen, battery storage would be examples in that category. On a more micro level, we're really thinking about individual investments. For example, if we buy a power plant, we're thinking about things like major storms, whether that's hurricanes for wind turbines or hailstorms for solar. How resilient are those, very specific assets in those very specific situations? So that's kind of how we think about climate resiliency in our shop.
Okay, so David, let's talk a bit about the investor side of it, because it sounds as if there's the potential for investors to be asked to take lower returns to accommodate an externality, which of course is climate change. I believe your views are quite different from that. Can you explain?
Yeah, particularly pronounced in the U.S., where I think climate change and issues in and around that perhaps fall on a wider spectrum than they do in other parts of the world. There's not kind of an overwhelming drive to be subsidizing these technologies from the investor. They really do need to stand, on their own economically. And the reality is, making this energy transition is so massively capital intensive. If you're really thinking about the scope of what we're trying to achieve, you really can't attract capital to that space any other way. For some smaller externality, can I raise, dollars in the millions? Yeah, perhaps, and perhaps you can find people willing to subsidize that endeavor. When we're talking about energy transition, we're easily into the billions and probably, into the trillions over the course of just a few years. To attract that type of capital, the individual investments really do need to make economic sense and stand on their own. Interestingly, for particularly wind and solar at this kind of stage in their evolution, they really are no longer niche. They're really kind of part of our larger power electricity supply in the U.S. And that's all being driven by the economics making sense for the consumer and, of course, for the investor. Generally, if there is a flex in the system or in the economic chain, the flex comes in terms of power pricing, not in terms of lower returns. So power pricing will go up to accommodate the investor rather than the investor kind of coming down in terms of returns to subsidize the power price.
Okay, so now what is the interplay between climate resiliency in energy infrastructure and the consumer or buyer? You've alluded to it in terms of pricing, but for example, how is the process of corporate goal targeting driving behavior towards renewable energy today? Because it seems like that's happening in a lot of industries and sectors of the economy.
Right. Well, for corporates specifically, it's been a very interesting evolution. And I would say before 10 years ago, you had very few corporate buyers. Most of the power was purchased by utilities who then sold that on to corporates and obviously commercial and residential customers. About 10 years ago, that started to change, and corporate buyers who are buying power directly from the source, from independent power producers, probably makes up half or maybe more than half of the market right now. So it's important to know that there's kind of now a direct link between corporate decision making and power purchasing, and it's not going through the filter of a utility necessarily. That's kind of an interesting dynamic, because to the extent that a corporate has goals driven by shareholders, driven by their customer base, those are playing out in terms of affecting their demand and their actions, and then they can have a more direct bearing on kind of influencing new power plants being built. On the overall, though, backing up, assuming you have corporate buyers and utility buyers, the really interesting point to renewables investing, I think, and I've been in the industry about 30 years, is that if you look between 2010 and 2020 specifically, you saw the effective price of power from wind and solar just come down a cost curve. And so the picture is just much different for the consumer. You've got very cost-effective power. So if you're a utility, for example, and you don't want to raise rates on your ratepayers, in 2010, that would have been hard to buy solar and then not turn around and raise rates. In 2020, and certainly is the case today, you can buy solar, and in fact, that's actually very cost-competitive power. And so not only do you not need to raise rates for your ratepayers, it's actually providing a bit of a subsidy in certain instances. So it's now very attractive for the consumer, and it's really is just cheap electrons. No matter what you think about climate change or green electricity, the reality is it's inexpensive power, and it's part of our power supply. And so on the consumer side, it's an absolute win, no matter what your perspective is.
I buy clean energy through my local utility, and they provide both types of energy resources, both clean energy and energy driven by fossil fuels. And it's interesting to see that the prices fluctuate, and sometimes the clean energy is less expensive than the fossil fuel energy. And it kind of goes back and forth, but I think that's kind of what I'm experiencing as a consumer. Now, while some of the impacts are positive and obvious, like this one, sun as the fuel, displacing coal, for example, what are some of the ripple effects? And what about energy security as an investment factor? That's one of the things that a lot of people seem very concerned about regarding our entire grid system in the U.S., for example.
Sure. Yeah, in terms of resiliency, this energy transition, the shift to more renewable assets, is affecting other things secondarily. One, and probably the most obvious, is our transmission system. We need a lot more transition to support these new assets. Our demand for power in this country is constantly growing, and so we need to expand the transmission system. We need to make the transmission system more robust. And it's ushering in things like smart grid technologies, which, are different ways to use the transmission system. Once upon a time, we built huge power plants outside of cities and then moved power in one direction from the power plant to the city. Now we have power plants situated outside the city, inside cities. We're thinking about ways to move power both directions along wires, in and around issues like a line going out, for example. So our transmission system continues to be improved. Part of that is this new generation. Part of it is happening outside of that, just utilities specifically thinking about different ways to use their system and making it more robust. The second is distributed generation. Again, when you've got, we always used to talk about wind plants. When one turbine goes down, 1/100th of your power plant goes down. If you have a gas plant, for example, if one turbine goes down, 100% of your project goes down. And so I think, and this for wind or solar, definitely is the case that the more resources you have pushing power into the grid, the less susceptible they are to any specific factor like a storm or a line going down. The last one I'll talk about is water, which really doesn't get, I think, the airtime that it deserves. If you're using nuclear, coal, natural gas, you're consuming a tremendous amount of water. And I mean, if you live in the U.S., I'm sure that's one of the things that you're thinking about is water supply, water scarcity, particularly freshwater scarcity. And so when you think about fossil fuels, there's actually a lot of water being used in those systems. So when you get away from that, thinking about solar and wind specifically, you're really kind of protecting our water resource in addition to everything else that you're doing on emissions. In terms of security, it's an interesting one for the U.S. We do have a lot of, coal. We have a lot of natural gas in the country. And I think some people do a bit adopt a view that those fossil fuels are unlimited and we can easily just kind of be self-sustaining as just the U.S. I think, particularly as of recent events, I think people are starting to realize how dependent we are on Canada for some of that resource, and is that a good thing or a bad thing? The U.S. on the energy security front, I think, probably is a little bit less sensitive than, for example, Europe. And when Russia basically turned off the tap for natural gas to flow to Western Europe, energy security became the absolute prime mover for how people thought about energy and reliability of supply over the long term.
So let's talk about the global perspective. You've focused some attention, understandably, especially on the U.S. and in Europe, but let's expand that map. What are some of the key considerations for investing in the energy infrastructure space from a global perspective, and how are things like nuclear and clean energy participating in that process?
Sure. Well, some of the main considerations I continuously tell people: one, there's no silver bullet in this energy transition. Solar's not going to carry all the weight. Wind's not going to carry all the weight. Nuclear is not ultimately going to carry all the weight. We're actually going to need a combination of all of these things. So as you look at the space, all of these things come into play, and they'll come into play at different rates in different countries, depending on the resource and what's available. So that's one consideration, and I don't think that one technology is going to come online and suddenly displace the rest of the fleet of operating projects. One thing people kind of underestimate, I think, is in a transition, you're not suddenly going to have some magic technology come along and immediately and rapidly displace all the other technologies, including fossil fuel, including wind and things like wind and solar. To provide energy to the world is a massive endeavor. You're going to need a massive build out of new projects, and that simply cannot be done overnight. So even if technologies continue to improve, continue to get more cost effective over time, it is going to be a relatively slow transition. The second thing I would say just about investing and something to think about is we've certainly run into investors who have, particularly with solar, have kind of a buy it and set it and forget it mentality. Think about solar as more or less a bond. And we would caution people, and I think there's been a lot of hard lessons learned, that all of these power assets, just simply are not set it and forget it. They all require active management, even as passive as you think a solar project might be. There's actually a lot of technologies going on there. There's thousands of panels in a utility scale project and ancillary equipment, and all of that needs to be continuously maintained. So the kind of the caretaking of these things just cannot be underestimated. On nuclear, that's a topic that comes up very frequently. I think people see it as maybe the solution straight across the board, because there's no intermittency once you've turned it on. It doesn't produce carbon once it's running. But the caution I would have for people on nuclear is, we've only built, I think, 3 nuclear plants in the U.S. in the past 20 or 30 years. And those plants, when they've been built, have been very costly to the ratepayer. And so the cost of implementing nuclear on any scale has to be a consideration, because ultimately you, the ratepayer, the consumer, is going to pay for it. And then I think people somewhat also underestimate how relatively easy or difficult it might be to actually start implementing nuclear in this country. I've spent a lot of my career developing projects, developing wind and solar, and I think you'd be shocked at how many people resist having a solar project in their community, even when it sits in a cornfield that, when the corn grows high, you cannot even see it unless you're literally standing on the edge of it. Then I think about permitting new nuclear plants and how difficult that may actually prove in practice. So I think nuclear is going to be part of the solution. I think it's a good one. I just caution people that it may not be a rapid deployment and kind of the one-stop shop solution that people make it out to be.
You're making some very good points about all of these resources, David, and we didn't really include any questions for you on artificial intelligence as a technology development that's very much in the news, at least, about how energy security is going to develop. Do you have any thoughts on that you could share with our listeners? Because all of these systems obviously take years to build out. They're energy intensive themselves in the process. What about artificial intelligence? How does that help us, or does it help us?
Yeah. I'm not sure if artificial intelligence necessarily is of great assistance. I think short of our artificial intelligence are interesting things, particularly in and around smart grids. And I think if you look at the ideal model, might look something like, a line goes down at a utility. Instantaneously, they can turn on one power plant and turn off another power plant. Instantaneously, they can route power different directions on different lines, all the way to you have smart appliances in your home which communicate with the grid. And for example, in one of these situations, turns your air conditioner off or doesn't allow you to use your clothes dryer or your toaster, right? Conserving energy on that end. Just thinking about the combination of all those things and how they might prevent blackouts or brownouts and keep critical systems operating. I think all of that is very interesting. I think as you go down that road, you just continually need to make an assessment. Is that incremental benefit kind of worth the cost? Now, on the flip side, just talking about AI and how that's going to make a push into kind of our everyday life. The same with data usage. Interestingly, for me, being in the industry for 30 years, data centers and some of that is AI. Data centers really are an incredible catalyst for new demand in the U.S., and it just can't be underestimated. I've just not seen anything like that in my entire career that's going to push demand for power and green power so rapidly as we're seeing with data center deployment.
Great. Well, David, thank you very much for your time today. And we're going to move on to Craig now. So hello again, Craig. How are you today?
Yeah, very well. Thank you.
Good. So, Craig, let's start with you telling our Sustainable Finance Podcast followers what Schroders Real Estate means when you add the words climate resilient to the investment description. David's shared a lot of information, and a lot of it has to do with real estate. So help us out here to get more clear about what kind of investments you are choosing for the Schroders Real Estate portfolio, for example.
Yeah, great. Thank you. So when we're talking about climate resilience in real estate, what we really mean is looking to optimize buildings so that they can mitigate both their impact on climate change, but also to withstand forthcoming impacts of inevitable climate risks as they're increasing and their intensity is increasing. So we utilize, if we're talking definitions, we utilize a Better Building Partnership definition. That's a UK sort of sector group of climate resilience, and that covers three main points. It's climate mitigation, and by that we mean reducing emissions to therefore reduce our impacts, also reducing our exposure to regulated taxation or penalties, and increasing our attractiveness to investors, whether that's through improved performance, improved access to capital, and so on. The second leg of that is climate adaptation. Really what we're trying to achieve there is the prevention of major financial losses, either at building level or broader, but also to anticipate major market disruptions as a result of climate change, and also from a positive perspective, seek co-benefits for nature and social impact and social value. And then the third part is disclosure. So we're talking effective disclosure both internally and externally to support decision making, but also to support third-party indexes, benchmarking programs, so that we can continue to contribute to best practice. From a transition risk perspective, so climate resilience factors in both transition and physical elements. From a transition risk perspective, the net zero conversation, the energy efficiency conversation, and the source of energy, which of course David has been covered a lot, that has been a topic for real estate for a long time now. And we've seen a particular increase in the effectiveness of that conversation in the industry over the last, say, 3 to 5 years. But coming up with that now is the physical risk element. And it's critical that we, as investment managers, incorporate physical risk and opportunities into that definition of climate resilience. There are a number of frameworks and regulatory protocols that help us do that, whether that's just voluntary mechanisms or disclosure. And essentially what we're looking to do there is combine the two elements of transition and physical risk so that we get a holistically resilient property or group of properties. So that's really what we mean by climate resilient investments.
Okay, so now climate resilience, it matters a great deal in this asset class because the world depends on real estate infrastructure, especially as we keep having more and more millions of residents in all of our large cities, which are the largest ones of which around the globe are going to be housing tens of millions of people each in the next 20 years or so. So why does it matter so much specifically in this asset class?
Yeah, it's a really important point because, as you point out, we all rely on buildings. We all rely on real estate, whether we live or work in them. And so it's a critical asset class to really focus on this agenda. So 39% of global energy-related emissions sit with buildings. And within that 39%, 28 of it, 39, relates to the operation of buildings, and then the remaining 11% or so is from construction. So if we marry that with the fact that around 80% of the buildings that we have today will remain in 2050 and beyond, and that the embodied carbon in development and new construction is so great, we really need to focus on adapting our existing building stock. So that's from an energy and carbon perspective. From a physical risk perspective, as you mentioned, real estate is critical, but it's also static. So at a building level, we have to focus on resilience, but we also have to consider how we might manage or be affected by exposure to infrastructure, the transport links that get us to our buildings, the road networks and rail, and also to the systems that support those buildings. And if they get impacted by climate change, even outside of our properties, we can still see an impact. So it's becoming increasingly clear that climate change is happening as we expected. In some ways, the worst case, we've seen a fourfold increase in frequency and severity of extreme events since the 80s, which feels some time ago. But if we bring that perspective forward a little, 2024 was the warmest year globally on record, and the last 10 years are the warmest decade on record within Europe, being the fastest warming continent on the planet. So as a result of that, we're seeing a significant increase in the number of $1 billion damage events globally. And we'll have seen across Americas, Europe, Asia, and Africa, the magnitude of rainfall, the severity and scale of wildfires, drought, and storm damages is increasing. And buildings, because they're static, cannot get away from those. And so that's why we really must focus on adaptation and resilience. From an investment performance perspective, climate impacts could affect income, costs and outgoings, market valuations, and access to capital, or attractiveness to investors. And when we think of that from a transition perspective, a carbon perspective, efficiency is key, both in terms of consumption and cost of resources. By increasing our resilience to climate impacts, by increasing our net zero performance, we protect ourselves against energy price volatility. We increase energy security at an asset level or building level, and that therefore increases security for our occupiers by minimizing their exposure to that, and also minimizing any shifts in markets or service charges. We can also see risks to insurance premiums, a topic very hot in the US, of course, with insurers pulling out of whole markets because of exposure to climate risk. That's less of an impact in places like Europe and the UK, where we have better reinsurance programs, but still something to consider. And then, of course, there's the ability to occupy and use those buildings. So reduced occupancy, reduced operability can lead to things like difficulty in reletting, difficulty in securing extensions or regearing of leases. And then if we think about the fact that many occupiers will have their own ambitions, whether those are corporate CSR or ESG related targets, or just ambitions for the spaces that they want to occupy. All of that builds into this picture that by investing in improving the performance and resiliency of our assets, we provide better spaces that are more secure and more attractive. And so if we move from the sort of negative risk element into the opportunity part, what we're really facing here are creating resilient hubs for people and businesses in risk-prone areas, and hopefully, therefore, supporting what we would call a just transition, and creating places where people want to live and work, and doing that through reducing things like overheating, reducing solar gains, improving ventilation and controls, and providing access to green spaces and community facilities. So that all links into this broader co-benefit of occupier health and well-being, social inclusion and value, even nature-positive interventions at either the building level, but also city or regional level. All of those things can be captured through investing in climate resilience at a property level. And then moving on to more financial metrics, as I say, we can reduce costs of operating. We can also reduce the maintenance and replacement costs of equipment in buildings as we move to more efficiency and therefore less run times, less competitiveness between heating and cooling, etc. So all of that then wraps up into what we would call a green premium, and there's increasing evidence for green premium. Often that is limited to sort of core markets, and the investment case is clearer in things like offices, for example. But the evidence case is building that there are actually higher capital values available, higher rent incomes, quicker and easier and higher levels of leasing and occupancy as a result of providing positive sustainability related and climate resilient buildings. And the converse, of course, is true, which we would call a brown discount.
Okay. So, you've mentioned a really important point in that there's really two parts of this process, especially in large cities where, for example, in New York City, there's like 100,000 buildings that should be upgraded in terms of their resiliency and their adaptation for climate change issues. Who is really in charge of that process? Obviously, local laws make a big difference. Companies need to adapt and upgrade systems, and they can be penalized, obviously, through regulatory infrastructure if they don't in a big city, for example. How fast is that process going to take place in countries like the U.S., in cities like New York, in places in Europe, and then again, how is that process going to unfold in different parts of the world, and how do you implement climate resiliency into the investment process when you are making those choices on a company by company or country by country basis?
Yeah, interesting question. So there are a lot of drivers for focusing investment into energy efficiency, carbon efficiency, and physical risk resilience. That the way that they will transpire, I mean, we already have considerable regulation in the UK and Europe. There are often city or regional or rather state level regulations driving a lot of change in the US. I'm less exposed to sort of some of the southern regions, unfortunately, so I'd be hesitant to comment too much on that. But certainly we're seeing a shift in regulation, taxation as well. So carbon prices and carbon taxes, often again at country level or state level, perhaps in the US, coming in to drive that. And that therefore exposes either occupiers or asset managers or contractors, developers to increased financial implications, but also regulatory and market reputation risks. To combat that type of thing and to combat those risks, we implement a process of reviewing climate risk, both from transition and physical, throughout an asset lifecycle. So that starts at acquisition, and it factors through then for the management, active management of buildings, refurbishment and development programs and toolkits and guidelines, and all the way throughout to disposal, and making sure that the communication between transactions is also improving in terms of what risk and opportunities are and costs are related to transitioning those assets. And so what the slide here talks about is how we would approach a sort of climate review when we look at investments or how we manage our investments, starting at the top with collecting data. First and foremost, you need to understand how a building operates and functions today, and therefore you can assess that against a baseline, normally with sector level frameworks. For real estate and a transition risk perspective, that's typically the Carbon Risk Real Estate Monitor, or CREM, particularly in the UK and Europe, and that's become sort of an industry standard where we can set our assets or compare our assets against energy and carbon reduction pathways between now and 2050. So it gives us a profile with which assets need to go along, and we can assess what we would call a stranding year for a building, and that is where an asset ultimately is emitting too much carbon compared to where it should be on this profile, and any time that it steps over that line, you would refer to it as, say, a stranded asset. Now, there is a lot of conversation about how important it is to be unstranded, and the sector is sort of working that out at the moment. But it is a metric that investors want to understand about our own exposure, and also what we want to understand as asset managers, so that we can build in resilience in the future. So once we've understood the baseline of an asset, we then move into setting targets. So once we understand the opportunities that are building and how they compare against that pathway, we can then build out intervention pathways or recommendations for what can be done at a building level to get it back into pathway and towards net zero. Now we can look at an operational level. That's operational carbon. That means the carbon related to the building's day-to-day running, utilities, and so on. And then there's embodied carbon, which sits then into the construction and development phase. So the carbon locked up in materials, and you can set targets and baselines on both of those. Critically, what we look for is making sure that any investments into decarbonisation as a sector, we try to follow what's called an energy hierarchy, and that reduces our reliance on energy in the first place, optimizes buildings to become the best performing that they can in terms of management, but also technology. And only as we start reducing its actual load do we then consider things like renewable energy supply and then offsets at the end.
Okay. Now, let's talk about starting with the good data and integrating transition and physical risk tools into the process, the asset business plan for individual assets. Just touch quickly on that process. Is you've got the tools that you use at Schroders to make these assessments. How is that done?
Yeah, so we start by seeking good data. We always seek to improve the quality and quantity of data that we can collect. Good data equals good recommendations for asset managers and fund managers. So there are countless technologies and engineering-based solutions that we can implement to improve that situation and improve our understanding of data. However, we do also have the ability to support real data with benchmarks and assumptions, or even internal benchmarks and frameworks, so that we can get this whole building or whole investment view. So although high quality data is critical, and obviously the better data that we have, the better we can disseminate to investors and clients, and also the sector, and improve our benchmarks and so on. What we need to do is move beyond purely focusing on data and actually start shifting our focus into actions where we can identify macro trends in performance gaps, what intervention needs are across different asset classes and different geographies, so that we can really start to build out a framework of how to decarbonize or how to implement adaptation and resilience plans at building level. So that's what we're aiming to get to. From our perspective, how we go through that process, we use a series of third-party and external tools to assess our decarbonisation risk and opportunities and our physical risk, and we bring that into sort of a holistic set of targets and objective setting with asset managers. We take that, as I said, from the acquisition process all the way out to disposal. So we use a set of proprietary toolkits like ESG scorecards, where we can assess performance of buildings against internal or external benchmarks. And we integrate the outcomes and the finding of those into asset business plans on an annual basis. We have plentiful governance programs or governance structures in place where those risks and opportunities get fed through investment committees and through F&I related governance committees, so that we get a full picture of our entire investment opportunities, but also at an individual building level. And the process ultimately is to find opportunities where we can see co-benefits and make sure that where there's available capex or there are opportunities to get into buildings because of lease breaks or refurbishment programs, that we maximize the opportunities to do that. And so we are critically trying to find better ways to engage with our asset and fund investment teams to merge what we have as S&I or sustainability non-financial KPIs related to climate resilience and translate those into financial KPIs or merge them with financial KPIs so that we genuinely understand the investment performance, risk and opportunities by doing so. And as we merge them, we can then get a better idea about what's realistic, how much we can actually achieve, and in what time frame, and whether or not that's the right approach at a building level.
Okay, now let's talk a little bit about key challenges in implementing resiliency into real estate investments, where you're interfacing with real estate investment managers of the actual building infrastructure itself. How important are they to this process? And that's really sort of the last thing that we want to focus on today.
Yeah, so building managers and property management is obviously a critical element of moving these assets and buildings into a resilient status for where they are today. There are multiple challenges, of course, in doing so. This includes financial and practical feasibility, but also either absence of or identifying where the specialist knowledge exists. We have inconsistency in definitions of what net zero really is, but also the technologies and solutions to get there. And we have inconsistencies in reporting frameworks, KPIs, and modeling techniques. So all of this kind of comes together to create quite a challenge, actually, for us as asset managers to implement net zero carbon and resilient strategies. As a result of that, we set up a number of frameworks and sector groups, particularly for real estate, that are looking to identify ways in which we can simplify the process for capturing relevant KPIs and modeling, so that all players in the market are using the same information and presenting the same KPIs, so that we can communicate those better and really be able to compare individual investment decisions against others. So that's one key. We also need to understand really which of those metrics are important to us as an investor, and is it actually the stranding risk that I was talking about before with CREM, and is it that all buildings need to be unstranded, or is there actually a threshold by which we feel that that's an acceptable level of risk or opportunity? Of course, there are also challenges around other metrics in the market that people are using to identify resilience or climate risk. And often those can sort of blur the picture. So, for example, EPC performance or energy performance certificates, which is a building level certification for energy ratings in the UK and Europe. There are inconsistencies in the application of that certification, and there are also, or rating rather, and there are also inconsistencies about how important that is to investors and asset managers. And so that can often sort of blur the lines between being able to compare. And then from a solutions perspective, there are also challenges. So we see long return periods for investment in particular CapEx items or building system replacements, which might extend well beyond a hold period for an individual investment. And so what we then need to do is identify, well, how much of that risk and opportunity do we want to take on versus how much do we accept any implication for value or income at disposal. And from physical risk perspective, some may not have the tangible benefits that net zero do. So you're protecting against something that is potentially going to happen rather than it is. And if I may, finally, of course, it's not just about challenges, it is about opportunities. And so, as I said, we have the green premier evidence, but we also have a lot of frameworks coming together that really help us simplify the messaging. And equally, we are seeing valuers increasingly integrate ESG metrics into and decarbonisation metrics into assessments of value. And so early moving and early performance on those actually opens up a big opportunity for asset managers.
Thank you very much, Craig. You covered a lot of ground today. I'm going to bring David back into the conversation now because we want to know where online our followers for the Sustainable Finance podcast can go to learn more about Schroders Greencoat US and Schroders Real Estate, and how can they get in touch with each of you with questions about the issues that we have discussed in today's episode.
For me, it's probably easiest to hit up schrodersgreencoat.com, which has information about what Greencoat is doing not only in the US, but globally. And then to the extent that you want to reach out to me directly, david.boyce at schrodersgreencoat.com, all one word.
Craig, how about you?
Yeah, so the best place really to head is to schroderscapital.com. For us, there's a sustainability and impact page on there, which will direct you to a lot of our policies and reports. So I would start there. And of course, please feel free to reach out to myself as well, which is greg.morey@schroders.com.
Terrific. Well, thanks again very much to David Boyce, head of Schroders Greencoat US, and Craig Morey, climate lead at Schroders Real Estate. I'm your host, Paul Ellis, and the Sustainable Finance Podcast followers can join me again next week for another episode.